Chart of the Week with Redmayne Bentley.
You're listening to financialradio.co.uk. My name's Giles McMullen, chatting to Bill Rook from Redmayne Bentley about his charting selections this week. Bill, again, it hasn't been an easy time to be in the markets, has it?
No, it hasn't, and one has to keep a level head and the cash balance reasonably high. Looking for commodities, looking for visibility of earnings. We discussed a little bit earlier that we have to have shares which are coming through with good news flow and have got good earnings forecasts and getting upgrades. And that's the general backdrop of looking at shares, and preferably large companies. Smaller companies have a worse time in bad market phases than the larger companies. So larger companies, please, where there's liquidity, marketability, and you don't get a frenzied sell-off which is accompanied by market makers marking the prices down in an equally rapid state, creating a sort of a mayhem at the bottom there and a mess. So the illusion of, it's all going away from me, can be like in a quicksand arena, could easily be manifested if you're in smaller shares, if you're not aware. So smaller shares are very, very tricky in this market condition. Larger companies, please.
Okay, and we're going to look at the FTSE 100 now. We haven't looked at it for a while, and it was holding up remarkably well until about the middle of June, and then everything seemed to go a bit wrong for it. So just talk us through what this shows us.
Well, from August last year, it's been a mess, really. It's been a mess because it's the new high-low ratios at the top. They haven't been strong enough. We want them well above 70, and they haven't been there. The only time we got above there was October time last year. It looked good, but then it faltered. And when that came off, that was really, if one is going to be a purist and saying, shall I be, shan't I be, what should I do with the market? Unless you get a new high-low ratio holding above 70, it's not good. And this is the number of highs over lows over in the 350. So I'm looking at the whole span there, and this is how bad it is. It's really at the bottom there. But being at the bottom is another thing. It suggests something else is happening, and we cast a line down the chart here and see, well, on the indicators at this particular point, and we have, I reckon, a low point in the new high-low ratios. It's certainly coming up there. We've had that before on three other occasions where those vertical lines are going through, and accompanied with the slope at the bottom. This is the measure of the weekly slope at the bottom there on a 10-day basis there, and that's down to minus 100. This is low. This is very, very low. What it tells me is that the market is not going to go much lower without some form of rally. And what I've then looked at is the multi-frame MACD. Now, this is our divergence indicator. MACD is mainly momentum. It does actually tell you a lot more other things here. But in this particular case, it's diverging with the main market because the indicator isn't pitching in at new lows. It's actually not making a new low while the underlying market is, suggesting the indicator suggests that, to me, that there's going to be a reversal here. So it's pointing to some form of reversal, and I would like to think it's going to go to 6,000 plus, but we don't know. No one knows, but in this particular phase of the market, it's becoming very, very tricky to gauge where anything is going at all. But I would think that we're going to have some sort of rally very shortly. The other indicators also suggesting oversold. Bollinger Band, I've got a weekly Bollinger on a daily chart there, suggesting also that that's in an oversold state. And the RSI below 30, so all pointing towards some form of rally.
I mean, whatever sort of market you're in, whether you're in a bull market, a bear market, or a market that's moving sideways, you do expect the sort of moves we've had in the FTSE 100 to be followed by at least consolidation, if not some kind of move in the other direction. I mean, it's very unusual for markets just to keep on moving in one direction without any correction.
But the two phases of market, Giles, one of the crucial things, differences is we'll look at some other time, I'm sure, but the new high-low ratio, if it's above 70, we have a different market. We have a bull market phase. When it's below 70, it becomes this feeling of, there's nothing here. It's going to suddenly drop. It's going to rally, drop. So it becomes more helter-skelter, and you can look into so many other things here. It's murky pond here now. And that can change when those ratios change. And when the new high-low ratio changes to above 70, it becomes a different market. It becomes much more turgid, rigid, I should say, in a sense that it's buoyant and it doesn't drop very far. It's become bullish in a sense that it's it doesn't become this sort of state of suddenly it falls away because of bad news somewhere. It's much more supportive in that sort of phase, and we're looking here a phase of really extreme choppiness here, and potentially very tricky unless you're focusing on quality shares with good earnings flow and good visibility of where things are going and good company statements. We're going to end up in a mess. The whole thing here is it is tricky, and we know it's tricky. Stick to quality, and you'll be okay.
Now, the FTSE 250, I don't suppose we can talk about this FTSE 250 in the same sentence as you mentioned quality there, because it doesn't look that good to me. It's been a terrible, terrible performance for the FTSE 250.
Well, yeah, it has been. But don't forget, in the 250, we've had AMEC, we've had Wood Group, we've had Petrofac, and they've all graduated to the 100.
Yeah.
All the good shares go forward to the 100, and all the poorly performing shares drop out. Barrett Developments and Alliance and Leicester amongst them, they drop back into the 250, into the Quagga, into a further mess. So it's actually, we get some from the lower levels coming up, but there's a lot of domestic stuff in this particular index, and it's causing mayhem here. And again, this is I reckon verging on the oversold areas, because mainly here the Ulster Index. I know we shouldn't use one indicator, but the Ulster Index, which is a form of volatility, suggests to me that where there's vertical lines coming down, we see the middle one there where the things are lined up, and one can be choosy as to say, well, if you put another indicator in, it might give you something different. But I'm suggesting here, okay, we haven't got the average true range, that swing of 300 or 400 points in a day which we had in January, but what we've got here is a slope which is very steep on the downside, and we have an Ulster Index suggesting that we're getting to a point here where enough people are feeling enough pain that it's going to rally. Enough people are so I'm expecting some form of rally in the next few weeks on this index. So that's what I'm looking forward to.
Okay, now you mentioned a few constituents there. Let's have a look at AMEC because it's been performing very well, hasn't it?
AMEC has. I mean, it's the 13th best performer out of the 350 over the period of the year. It's yes, we could have taken a reasonable. There's a stop signal recently on this share, as you can see on the chart, but the volume levels have been reasonably robust. It's graduated from the lower levels into the 100 fairly recently, and it's held up reasonably well. Earnings forecasts are good. Some of the statements recently suggest the management underestimated the earnings growth potential here. It's great cash flow, great sector, and a company going places. It's just very, very strong. Would put a stop loss somewhere in the £8 level perhaps, but I'm happy to hold that share.
Would you be a new buyer at this level if you didn't own them?
Would wait possibly for, well, depends how you trade really. I mean, we've been topping up on some of the oil equipment services sector, and this is in that area, possibly.
Okay, Bill. Now let's have a look at the actual sector itself, oil and gas. You've got a comparison chart here. Well, what does this tell us?
Well, one of the things we discussed earlier, Giles, is there's that some people have a view that oil's going to go up, therefore I'm going to buy BP or Shell. What actually they don't realise is that BP and Shell have had enormous rise of costs in refining. This is eating away at any profitability they're getting really from the benefit of the rising oil price, and this is reflected in the lower chart there. You can see the chart hasn't really done that much, and when looking at the upper chart, the upper indicator, they're suggesting, well, the oil price has gone up. How much am I making against that the underlying oil? I'm actually down 30%. If you bought the oil and gas sector hoping to outperform the oil and gas or mirror the actual oil price, you're to be down 30% against that. So in essence, if you have a hunch about a certain commodity or an index, it's probably better to buy that underlying using an ETF rather than trying to work your way through trying to buy an individual situation like a bank or in this case a BP or a Shell, because you're not getting the performance. So follow the underlying, and perhaps with a basket, I would say, within a basket. So you have a selection of heating oil, natural gas, and actual crude. So you've got a mixture in that basket. And likewise, if you're looking at grains, soybeans, wheat, and corn in the same basket, it's probably better than just picking one. So moral here is to go for the underlying and preferably in a basket.
I mean, you say down 30%, although in this market in 2008, down 30%, I think will be seen as quite good performance.
Well, against that, you see, but if you actually thought, well, you thought Light Sweep was quite good, and you're quite annoyed about not doubling your money in a year because you bought the BP and Shell. I mean, it just sort of you've been right by guessing where it's going to go, but wrong in your selection of share,
which is even more frustrating. Isn't it?
It is really. It can actually put people off the scent of what's going on. So it's better to try and go for the underlying. I think I'll have a basket underlying and then work from there.
Bill, as always, fascinating to talk to you. Thank you very much for your stock selections and commentary this week. We'll chat again next week. That's Bill Rook from Redmayne Bentley.
Thanks, Charles.
Chart of the Week with Redmayne Bentley.